Okay, so I'm going to present some work that I've been doing with Jamie Lenny and Louise Shaner. I do need to make it abundantly clear, and this goes, triply for any members of the press here. All the opinions I express are solely my own and my co-authors and not those of the Federal Reserve System. Same thing goes for the Bank of England. Okay, so I'm going to be talking about the fiscal sustainability of state and local government pensions. I'm going to ask, are state and local government pensions fiscally sustainable? And if not, what could be done to render them sustainable? I want to note, out of the gate, that this is very narrowly targeted at fiscal sustainability. We hope to expand this to look at a broader set of issues within the context of state and local governments, which is all to say I very much agree with Gene's point that you need to look at this in a broader context. Nonetheless, today I'm going to be focusing narrowly on sustainability. So past work has approached this question from what I'll term a finance perspective, very focused on establishing the size of liabilities for pensions. And it's done this by simply taking the present discounted value of pensions, discounting the future stream of promised benefits using discount rates set by market prices. And Josh, who we're going to hear from later, has done the most prominent of this work. And this work has been very influential, and it's had a real impact in the policy space for sure. We, though, are going to adopt a little different perspective. We instead are going to adopt a methodology just a bit more rooted in the public finance tradition in economics and look at some of the methodology that's traditionally been used to analyze pay-as-you-go pension schemes at the national levels for economies, as well as more broadly the sustainability of public debt. I do want to make clear, though, that there's absolutely nothing inherently in conflict between these two approaches. It's just the way we're going to look at it is going to give a little different viewpoint or vantage point. Okay, so just to preview where I'm going, in aggregate, we find pensions can be stabilized with moderate fiscal adjustments. And I do mean moderate, I do not mean small. It would mean some real fiscal strain, but it would probably be achievable over time under low and moderate asset return assumptions. One of the interesting findings we have is that under a lot of our stabilization scenarios, there's not a whole lot of return to starting the stabilization now versus later, but there's tons of heterogeneity. I mean, we've already seen that with Carol's talk. I'm very much going to be focused on sort of typical experience, not the experience of some of the poorly funded plans in Illinois, for example. Although the work itself does fully explore the heterogeneity, I'm only going to have time to give just a brief sense of that. Okay, so in terms of background, again, calculating pension liabilities requires a discount rate. We've already seen some discussion of this with some of Josh's comments, but pensions typically have used a very high discount rate based on their assumed return on assets. But pensions have very strong legal protections. They're relatively certain cash flows going forward, and this points very directly to a low, more risk-free rate. And when you use such a low discount rate, you end up with extraordinarily large unfunded liabilities. Josh's most recent work, as well as the work of my colleagues at the board doing the financial accounts of the US, puts the total amount at about $4 trillion in terms of unfunded liabilities. And this has generated just really widespread concern among academics, policymakers, and so forth. Nonetheless, for the topic I'll be talking about today, it's worth noting that pre-funding is not required for fiscal sustainability. To illustrate this, just as a thought experiment, you can note that fully unfunded pay-as-you-go pension systems can be fully sustainable with no pre-funding whatsoever. And I do want to emphasize here, this is a thought experiment. We're not advocating plans go to fully pay-go, nor will we analyze them as fully pay-go. But it's a very useful thought experiment to illustrate some points. It's been understood since at least Paul Samuelson's work in the late 1950s that pay-gos can be sustainable if the internal rate of return paid to retirees does not exceed the growth of the wage base. It's very intuitive, actually. You can pay current retirees out of the cash flow coming in for contributions for current workers as long as the increment that the retirees receive above what was put in over their working life doesn't exceed growth in the wage base. And then but of course, pay-go systems can become unsustainable. Demographic or economic shocks can increase outlays or decrease revenues and destabilize them. And of course, most of the advanced economies are currently having their national pension schemes to be somewhat destabilized by the retirement of the baby boom generation. Policymakers increasing benefits is another way in which this can be destabilized. Hybrid systems, and I want to define, we're using this a bit idiosyncratically here. I'm going to define a hybrid system as a system that is partially pre-funded and therefore partially has a pay-as-you-go aspect. Such systems can be robust in the face of shocks, at least for a time, simply because they have assets on hand to cover them. And I'm going to show here that most state and local pensions have effectively long been operated as hybrid systems that are only partially funded under appropriate discount rates. And we're going to analyze the pensions in this spirit as they have historically operated as hybrid systems. In contrast, most, not all, past work has focused on a full pre-funding benchmark. And just to make the point that the way we're looking at this is very consistent with the historical background of these plans. Here you have, going back to 2002, the funded ratio in aggregate for state and local government pension plans in the US under a low AAA corporate rate, which is what the Financial Accounts of the US uses. And here you see that, in 2007, they topped out at a little over 60%. The data becomes a little sketchier going back, but if you look even back to 1978, 1 in 6 plans had no pre-funding whatsoever. Only 25% of plans were even contributing enough to present liability growth, and 1 in 4 local plans did not even employ an actuarial valuation and could not even state their degree of unfunding. So it's just a historical reality that under appropriate discount rates, this is how they've operated over time. Okay, another way you can conceptualize what we're doing here is to note that unfunded liabilities are nothing but a form of implicit public debt. And public debt, in theory, can be sustainable at times with no fiscal cost, which is just simply to say you can roll over debt with no need to adjust taxes or expenditures in the right scenario. That simply requires that the rate of interest, R, equals the growth rate in the economy. This is also intuitive. Here, each year, your stock of debt is going to increase because you have to pay service payments on the debt, but that will simply be extinguished by the growth rate in the economy, holding the ratio constant. And this is a point that's been getting a lot of attention as far as the federal debt goes. Olivier Blanchard made it the topic of his AEA presidential address this last year. And as we show in the paper, this condition also very much holds for pension debt. Under the right scenario, it can be stable at no fiscal cost.
Just a point of clarification. Unfunded pension liabilities are a type of implicit public debt that under current arrangements gets a lot bigger when the stock market goes down. Isn't that right?
Yes, that's true.
Okay, so maybe something to keep in mind, for us to keep in mind as we go on, right?
Yeah, I mean, if you wanted to incorporate that, you would have to decompose the standard R minus G debt dynamic equation to accommodate both assets and the discount rate R, and you could certainly do that.
What, a model something where you have states of the world,
yes.
fantastic process for assets.
So Josh, we're going to give you a chance to. That's okay.
I just am excited.
We're all excited.
Okay.
Would you like me to hold my comments to the panel? Or would you like me to hold my comments to the Q&A?
No, panel. You're the panel. You're there.
Josh, So Josh, I have a fair, but since that was just raised, I will address it. I have a fair bit of sympathy for that, and another project we would like to do next is going to make fully stochastic asset returns with some long-range assumptions, and then try to map out the full distribution of possible outcomes under certain scenarios that try to stabilize the debt. And I think this would capture Josh's, and I think that would be very worthwhile to do. So I have a lot of sympathy for that comment, not what we're doing today. Okay, you have to have some caution required on this. Just because pension debt can be sustainable in principle, it need not be so in practice. And in fact, I'm going to show that pension debt is currently not sustainable in aggregate. Okay, so I need to move along in terms of data. Most of the data we're using is pulled out of the annual CAFR statements and actuarial valuations the plans have to issue. We're going to extrapolate up to the national level using a small sample of 40 plans. However, our sample is observationally, both in terms of mean observables and the variance around that, is almost identical to the universe of pensions. And in particular, we have plans that aren't particularly well funded, like the Illinois Teachers Plan, and plans that are better funded, like the Illinois General and Municipal Plan. Okay, in terms of methodology, in order to do a sustainability analysis, you have to have the full future cash flows that have been promised in benefits for each plan. These are not often provided in the actuarial reports, and so we're going to reverse engineer them using the technique that was in fact pioneered by Josh and his co-author Robert Novi-Marks. And we're going to do this by collecting a mass of data on demographics for the plans and their current retirees, and a whole set of information on the benefit parameters that determine benefits. And then we're going to construct some statistical machinery to age workers and retirees. So each year we're going to apply quit, disability, death, and retirement probabilities. Surviving workers still in employment with the state and local government are incremented a year of age and service. They receive a wage increase. Probabilistically, a certain number of them reach retirement and start receiving benefits. And in that way, we build up from the atom level all the way up to total benefits. This is simple conceptually, but in practice, it's extremely challenging. And there's a large appendix if anybody's interested, but I'm not going to have any time for that. Finally, we harmonize our assumptions. We require everybody to use the same discount rate, assumed inflation rate, wage growth, and asset returns. We use some fairly off-the-shelf, long-run population and GDP growth assumptions. And then we add in new hires each year such that the ratio of state and local government employees to the total workforce in a state remains constant. Okay, so here are some of our results. This is the demographic modeling. Here we see the ratio of pension beneficiaries to the state and local government workforce. The total is in black here. The red line shows retirees. They decline over time due to mortality. The blue line are workers employed as of 2017, the base year for our study. They rise as they move into retirement, and then mortality takes over. And then the purple line are new hires that are hired after 2017, who eventually become the whole cohort. Thing to note here, there's a pronounced upward slope here. It rises almost 40%. This is the retirement of the baby boom generation. This rise is very similar to what the Social Security actuaries get for the country as a whole, and gives us a fair bit of comfort that we've done this portion of the modeling correctly. Okay, so here are benefit payments, pension benefit payments to GDP in aggregate for the country as a whole. What we see is they're currently a little bit above 1.5%. The interesting thing here is that these benefits rise in a very muted fashion and then actually tail off over time. This is a pretty important fact because it means that cash flow relief is in train for these plans, although it's about 20 years out. And it raises the possibility that governments may want to do some smoothing over time to get through this period of peak cash flow demand. Now, this is a fairly surprising result. It really surprised us when it first popped out. And we've done a lot of work trying to decompose what's going on. Given all the increase in retirees, why don't we see benefits going up more? It turns out it's really two things. We've already heard about both these factors. The first is that plans have been pretty aggressive about lowering their cost of living adjustments over the last 10 years. And we can see that this can have really dramatic effects on the benefit levels. Our baseline result is here in black. In green, we have what happened if the COLAs were all nationally set to inflation, and you get a much steeper rise with full COLAs. The second factor, as we've already heard for Illinois with the Tier 1 and Tier 2 plans, is most plans at this point have introduced reforms for new hires, which give them reduced benefits, and in Illinois' case, radically reduced benefits. And this also has quite an effect. We can see here from the baseline to the red line that you get about a 12% increment decrease in benefits as a share of the economy due to these new hire reforms. when we put both the COLA and the new hire reforms into place jointly, you can see that we get a really steep rise in benefits as a share of GDP, much more in line with what you would expect given the demographics. Okay, so we'll now turn to sort of the heart of what we're trying to do. This is the sustainability analysis. We're first going to do a current policy analysis. We're going to assume that the contribution into the pension plan as a share of payroll is held constant at where it is today. We're going to discount we're going to calculate liabilities or pension debt using our risk-free rate of interest. And then we're going to consider 3 deterministic rates of return on pension assets. We do want to generalize this to a stochastic framework at some point. The first rate of return we're going to use is the 1.5% real return risk-free rate. This is the risk-free rate calculated over the past business cycle using the Treasury market prices. 5.5%, which is the expected rate. This will give us the unbiased expected fiscal projections, but is very clearly perverse because it makes no adjustment whatsoever for risk. And then the 3.5% real return, which is just a middle ground. I'm going to focus mostly on the risk-free and the 3.5% return. Okay, so here is what I mean when I say that the plans are not currently fiscally sustainable. Here we have the ratio of pension assets to GDP, and we can see that in the black line, which is the risk-free rate of return, the assets are gradually being drawn down and exhaust in about 30 years. The plans in aggregate become insolvent. This is not sustainable under sort of the standard way you analyze these things at the national level, at least. If you look at the red line, which is the 3.5% return, you get to run out further. You get about 50 years, but it's still unsustainable. You're on the path to insolvency. You are going to explode your assets if you have a 5.5% return, though. Okay, so under moderate and risk-free asset returns, the plans are not sustainable. What do they need to do to render them sustainable, which is basically fix the level of debt going forward as a share of the economy? We're going to do 2 exercises. One is a long-run exercise. This just determines the unique one-time change in contributions that, if held in perpetuity, that increase was kept in place, would eventually stabilize the debt to GDP ratio in the long run, but without any regard to the level of that debt. We're also going to do a 30-year medium-term exercise, which is the one-time increase in contributions that, if held for 30 years, would result in your unfunded liabilities as a share of the economy being where they are today in 30 years' time. So under this 30-year scenario, on net over 30 years, you're going to fully pay for all the benefits accrued over those 30 years, and you're going to do what needs to be done to avoid the existing stock of debt from rising as a share of the economy. Okay, so here is the long-run exercise. Under the 3.5% return, if you start today, you need to increase your contributions about 4 percentage points of payroll. To put this into context, from 2007 to 2017, excuse me, the state and local governments in total increased their pension contributions by about 7 percentage points. So if they did less than half of what they've already done over about the last 10 years, if they end up in a state of the world with a 3.5% return, they would stabilize their debt. That rises to about 8% if they start in 30 years. Of course, you cannot guarantee a 3.5% return. You are accepting quite a bit of risk for that assumption. If you take the risk-free rate, you're going to have to increase your contributions by 13% of payroll. The interesting thing here is that there is no particular return to starting now versus later, simply because the assets only grow fast enough such that they keep up with GDP, and they never end up throwing off any income that you can use to fund the plans. Okay, here we see what happens to the assets as a share of GDP. We see that if you start stabilizing immediately, they pretty much hold stable. You don't have much erosion. Same with 10 years, very little difference. If you wait 30 years, you are going to draw down your buffer considerably, and that is a clear downside. Okay, so I'm running out of time. So here's what we get if you get back to, on the 30-year exercise. The results are very similar for the 3.5% return. You need to increase by 4 percentage points if you start today, and about 9 percentage points if you start in 20 years. Okay, the last thing I really want to highlight here is this compares on the right-hand side, we have under the risk-free assumption what you need to do to end 30 years with the same pension debt to GDP ratio. And over here, we have what you would need to do to move to full funding over that period. And here you see the really dramatic difference. You have to increase your contributions by over 3 times more to move to full funding over 30 years versus stabilization. And of course, that's a public policy decision for policymakers to make about which one of those scenarios they would like to pursue, but both scenarios are stable in the sense that debt is not rising as a share of the economy. Okay, last thing here, just to point out tons of heterogeneity. If you look at the light blue bar on the far right, that's the risk-free return. And what that shows is that about 1/3 of the sample under risk-free returns is going to have to increase their contributions under the 30-year scenario by in excess of 20 percentage points. That is going to be a real strain. Some might consider that a crisis. So there's quite a bit of heterogeneity here. And I'm out of time, so I'll conclude with that. Thank you.